Hey Bowtie Nation, Joseph Hogue here with another one of these news-related videos. Loving these informal walkthroughs, news that catches my eye that I want to get the idea out to you faster than a polished, produced video. This week, folks, it is happening again, okay? All the signs are there for a correction in the stock market. I've seen it before, especially with those hot AI stocks that are so overbought, so overvalued right now. So I want to show you how I'm preparing, what stocks I'm buying in September to prepare for that, some of the safety stocks that are going to protect your hard-earned money. I'm also going to update you on shares of SMCI, Super Microcomputer, because I see everybody rush into the comments there asking for an update, and probably the most important lesson for investors right now. So make sure you stick around for that, because again, I see people rushing to the comments to ask for an update, but then they don't watch the videos when I do it. But first, there is another way to get updates in real time. See what stocks I'm buying and what's in my portfolio by joining me on the Blossom Social Investing app. I started using this app just a couple of years ago. I love it for getting ideas, sharing my portfolio, and just seeing what everyone else is talking about. I'm going to be speaking at the Blossom Investing Tour in New York at the NASDAQ market site, and then at the SIBO in Chicago in October. So watch for updates on that. I've shared my portfolio on the app. It's totally free to download, so look for the special invite link I'll leave in the description and check that out. But here I do want to get you ready because it does look like enthusiasm is coming out of the AI theme and it's affecting valuations. A lot of the stocks we're following, SMCI, NVIDIA, Broadcom, a lot of those stocks, Marvell Technologies had a big dip on its earnings. A lot of that's affecting the valuations. The stocks are coming down and it could lead to a broader market sell-off. Now, a lot of this recent sell-off started with OpenAI's Sam Altman, the CEO there himself, saying that yes, AI is in a bubble. Okay, so it's pretty powerful when the CEO of one of the largest AI companies or the most important AI companies besides maybe NVIDIA does say that, yes, we are in a bubble, and that could pop just like the internet bubble did. Now, that was followed up by a report by MIT that I think was a little bit questionable. I'm going to show you why here, but a report by MIT published on Fortune that said 95% of Gen AI pilots for companies are failing. Okay, it says just 5%. If you look through here, about 5% of AI programs achieved rapid revenue accelerations, while 95% of those AI pilot programs at corporations, so those agents, those Gen AI programs, were being scrapped. Now, I think this doesn't necessarily show what I think people interpreted it as. Okay, what it does show is that 5% of the in-house pilot programs for AI that are completely holistic and take over a portion of the business, only 5% of those did get implemented. Okay, the other 95%, there were some questions in it, and they scrapped those programs. Okay, but what it didn't show is that also about 65%, about 2/3 of the programs that were written off-site that were helped by some of the other software producers like CRM, like Salesforce. There, some of the other software, AI software as a service companies. 65% of those were put in place. Okay, so it seems when corporations try to go it alone, they try to create their own AI models to take over a part of their business, they're having some hesitation in putting those in service. Okay, and if you've used AI, you know why that is. You see, it does make things up every once in a while. It does. It doesn't exactly do what you think it's going to do all the time. So when you're going to put that in charge of your business, yeah, it's got to be perfect, okay? And that's just not happening, as we've seen. But what we are seeing is that companies are able to use AI, okay? I use AI in my business. I know a lot of people in large companies that use AI. Their employees use AI. It's just that these agentic programs that are supposed to take over the whole company or take over parts of the business just aren't living up to that level of satisfaction. And so there's been a lot of talk about the Gartner hype cycle, and this is a visualization of tech adoptions put together by consulting firm Gartner, just kind of show how those work out sometimes. Here, let's look at it so we can see the whole thing. And what they've done here is all facets of AI on this hype cycle. Okay, I would be more, I'd pay attention here to this generative AI, the AI agents, the two really big main theme AI facets here, edge AI there. Okay. So what this shows is that any new technology that really captures the market enthusiasm always goes through this hype cycle, okay? And I saw it in 1999 when I started investing with the internet, with the dot-com stocks. You saw it there in 2008. But really here, what we're looking at here is it first goes through an innovation trigger. Okay. What we saw a couple of years ago with ChatGPT showed us really the power of AI. Okay. And since then, we've seen all these apps, all these different kinds of models coming through, showing us exactly what we can do. But what we're seeing here is innovation trigger. Then you got that peak of inflated expectations. Okay. I would say that's this last year for AI. Okay. This last year where everybody is pouring into AI stocks, into AI agents, a lot of the companies trying to figure out what they can do with this. And what Gartner is saying here is that AI is now into this trough of disillusionment. Okay, this is always the come down from those initial expectations. Okay. Back then in 1999, we saw it with the internet, with the dot-com stocks. We thought these stocks were going to grow forever. It didn't matter if they were unprofitable. It didn't matter if they were burning cash like it was going out of style, that they were going to change the world, okay? When we figured out that that wasn't going to be the case immediately, when the Fed started raising rates, when it started making these unprofitable companies more expensive and that cash burn more worrisome, then yeah, they came into this trough of disillusionment, okay? But if you stayed investing, obviously, if you stayed investing in stocks like Amazon, which has now like 300 times your money since 2002, then internet did change your life, and that those internet stocks could have made you rich, okay? We get into the slope of enlightenment and then that plateau of productivity eventually with these technological advances. We'll get there with AI. We just have to get through this trough of disillusionment, this short period where companies are questioning the viability and the use of AI, when investors are looking at that and they're seeing some of the valuations come out of their stocks. And folks, again, I have seen this all before. Okay, I started investing right around here in 1999. Okay, a corporal in the Marine Corps, wasn't making much money, so I was bartending twice a week to try to make some extra money to put into the stock market, because it was making everyone else rich in those internet and those .com stocks, right? So I figured, why not me too? So I started investing here in 1999 and rode it up, but I didn't know what I was doing. I was just following the hot stocks, following the momentum stocks, and of course got caught in that bubble burst when the bubble burst in there in 2000. So yes, folks, AI will change our lives. Just as the internet did 25 years ago, some of these stocks that we talk about are going to make you rich, but you need to have the confidence to stick with it and stay in them, okay? Even if this correction goes into 6 months, even if it goes into a year of sell-off on some of these AI stocks, you need to keep holding them and you need to ride them higher over the longer term. To do that, to have that confidence, you're going to need some money in other stocks, okay, to help protect some of that hard-earned money so you don't see the full force of this sell-off. Like we saw the 50%, the 80% sell-off in the NASDAQ on that .com bubble burst, okay? That's what I want to show you right now. That's what I want to show you, how to find some of these stocks that are going to protect your money, because I've seen it too many times. 25 years of investing, more than 10 years as an equity analyst. I've seen it too many times, folks. Investors in 100% of these hot stocks, okay? Their portfolio is 100% in just a few names even. You need the others for safety, but you keep telling yourself that next month, or maybe next year, you're going to start diversifying. You're going to start getting some of those safety stocks. Then the bubble pops though, and you're up the creek, okay? You need to start shifting some of your money now, okay, with the 5 stocks I'm going to highlight in this video. Now to do that, we're going to start with valuations, then we're going to drill down into the sectors where you're going to get a better deal. We're going to look at the individual sectors and then the stocks within those that are going to be able to protect your money over the next 3 to 6 months until we work through this correction in AI stocks. Now we can see here the trailing 12-month price to earnings ratio, okay? So this is the price of all the stocks in the S&P 500, those 500 largest companies in the United States, the price divided by the earnings that they've reported over the past year. Okay, so those earnings, that net income, this is the core valuation metric for the market. Price over earnings, how much in price are investors paying for those earnings? And you can see this is at as high as it's been since the government was pouring money at the economy, pouring $7 trillion at the economy post-pandemic. Okay, if we go back even further, the market is as expensive as it has been all the way back to the .com boom. Okay, 28 times on that price to earnings basis, when over the last 10 years, the average has been closer to about 22 times, that blue dash there. Okay, so you are paying, if you're buying stocks right now, just the overall market index, you're paying a hell of a lot more. You're paying about 20% more. But then if we zoom into the individual sectors, okay, the 11 stock sectors of the economy, different pieces of the economy, technology, consumer discretionary, industrials, the S&P 500 there, we can see how each sector, the stocks in each sector within the S&P 500 are trading, how expensive they are in a sector level. You can give us an idea of which sectors, which groups of stocks are a better deal right now and which will have less room to fall. Okay. If we look here, so this is the forward 12-month PE ratio. Okay. So this is forward means analyst expectations for the forward 12 months. Okay. So this is the price of all the stocks in each sector, all the technology stocks in that sector, all the energy stocks in that sector, healthcare stocks in that sector, the price of all those stocks divided by what analysts believe those companies are going to report for their earnings over the next 12 months. So it's a little bit more of a forward-looking price-to-earnings ratio than that trailing one that we saw just a little bit ago. But we do see here with the S&P 500, the broader index, priced at 22.4 times, that dark blue bar, 22.4 times forward PE ratio. That is well above the 18.5 times 10-year average. Okay, so that is still very much at a premium. You look at some of these others as technology stocks, almost 30 times on a price to earnings basis versus 22 times 10-year average. Okay, so trading right at about that 27-30% premium more than they've traded at on average in the past. Okay, so if we do get some kind of a sell-off, if we do get a market correction, those stocks are going to come down harder probably because they're going to come down closer to that 10-year average or even beyond. Okay, but if we look at some of the more value sectors here, energy, healthcare, we've got real estate there. We've got where those dark blue bars are close to or even below where that green bar long-term average is. Okay, you can see energy stocks trading for 15.3 times on a price to earnings ratio versus 14.8 times. Okay, right about there, just a little bit above where the long-term average is. Healthcare also trading 16.5 times on that long-term or on that PE ratio versus 16.3 long-term average. Okay, and real estate, we don't have a longer term one because they just kind of reshuffled the real estate sector there in the S&P 500. But we have the shorter term 5-year average trading right now at 17.9 times on a price to earnings ratio below the 5-year average of 18.9. So that one is a value sector. So then here what we can do, we can go to the sectorspiders.com sector tracker. Okay, this is showing the returns on each sector, the stocks in each sector over the 5-day, 1 month, 3 month, 1 year, all the way up to 5 years. I've got it to the 1 year here, and we can see some of those safety sectors that have underperformed. Okay, real estate underperforming because of high interest rates. The trouble in the commercial real estate markets. You've got healthcare coming down because of a lot of the insurers are getting hit. A lot of the drug makers are getting hit on tariff threats. You've got energy stocks coming down on lower oil prices and weakness in that market. But these are the value sectors. These are where you're going to protect your money. You buy into these because those stocks are already at value territory. Okay, they are already trading cheaply. They don't have a whole lot further to run or further to fall if the stock market is sell off. Whereas you've got stocks here in the communication services, a lot of your internet stocks there, your technology stocks here up 24%, up 31% over the past year. Those stocks have a lot further to fall if we do get a correction. Now, what you can do here is you can find your safety sectors like we did, energy, healthcare, and real estate, and you can click on here to see what stocks or examples of stocks in those. So if we look here on energy holdings, obviously you've got a lot of the midstream makers, the midstream pipeline people like Kinder Morgan, which is a favorite here on the channel. You've got equipment makers like Baker Hughes, drilling services. I think the Baker Hughes is going to do very well. I think this is where you're going to see a lot of the upside in oil stocks and in energy companies hit first is in these oil services companies because they're going to be contracted to dig those new wells and to really provide those services as the industry comes back up. But you've also got the explorers, okay? Some other favorites, Devon Energy here, down 18% over the last year. You got EOG Resources, big name in natural gas there, up down 2.5% over the last year. ExxonMobil, one of the largest there, down 3%. So a lot of the developers getting hit on those lower oil prices, but with a lot of upside potential. You got Diamondback Energy, ticker FANG, here 24% down over the last year. If we go into the healthcare sector here, 60 stocks within the S&P 500, those largest 500 companies in the United States, they're in healthcare. So we can look through here some of the stocks that we like. We can look at United Health Group, the UNH, the HUM Humana that we've been following all year. Those have started to look good over the last 3 months. Those are up, but they're still down huge over the last year, down 48% for United Healthcare there. So I think this is the time to start buying those stocks in that value territory on their way up. You've got other ones here. You've got Merck. You've got some of the larger drug makers. Eli Lilly, very well attractively priced here. Ticker LLY, down 22% over the last year. You've also got Amgen. There's Humana, ticker HUM, down 14% over the last year. And real estate, just 31 stocks here in the S&P 500 within this sector. You've got some names here. Iron Mountain, a very stable play normally, down 20% this year. I think that's an attractive valuation opportunity here in Iron Mountain because it is a very stable, stable cash flows there. Healthpeak Properties, you've got other ones. American Tower. I like the cell tower REITs right here just because of the need for that networking for those towers there with the AI theme. So you've got AMT, Public Storage. Americans love to buy shit they don't need, and they always need a place to put it, okay? If you look in the garages around your community, they are all full. People parking in their driveways because they got shit packed to the rafters in their garage. It amazes me, folks, but people just love to buy more stuff than they can store. That's going to mean these storage facility stocks are always going to do well. I like Public Storage there, as well as some of the data center REITs. Okay, you've got SBA Communications, another cell tower REIT there. Equinix, a data center REIT there. You've got Digital Realty somewhere here. Digital Realty Trust, ticker DLR. Up 7.8% so far over the last year, but it's still in value territory. That stock usually does much better than 7.8% per year. So still in value territory there as well. Now I realize that was more than 5 stocks there. I get carried away sometimes talking through stocks, talking through some of my ideas here. I'm going to flash which stocks I'm buying here in September, the main stocks that I think are really going to protect your money if we do see further downside on the market. We do see here that Super Microcomputer, ticker SMCI, down about 5% over the last year, but that's not what has investors freaking the F out, right? It's $60 here the last few weeks, down to 40 now. It's about a 30% drop here in just a few weeks ago. People rush into the comments asking for an update. In fact, I did an update just 9 days ago, folks. Okay, 9 days ago, I updated on Spotify, on SMCI, why I think those are great long-term investments. But the problem here, and again, if you get one thing from this video, folks, the biggest lesson in investing, you need to be doing some of this research yourself to have that confidence. The problem is investors don't have the confidence in their investments because they're just following some YouTuber into a stock. In fact, I see a lot of these other channels just posting the stocks up in the front of the video. These are the stocks I'm going to recommend. People rush out to buy those without any research themselves, and probably without any research from that channel as well. Okay. The problem here is that research, what I'm going to show you here in a little bit about SMCI, the research that I've done, not only going to show you which stocks to buy, which stocks are the best in their group, but it gives you that confidence to sit through these corrections, to sit through these drops, okay? You can see here that over the last year, shares of SMCI, when we really started buying a little bit in September and October of last year, here around $40 a share. It really started loading up there when it hit $18 and $20 there in November, and just kept buying, okay? And yes, it has been a roller coaster. If you are not doing the research in your stocks, folks, you have no business being in a stock like SMCI, okay? You know, from $20, from $18 here in November, all the way up to 40, and then back down to 28, okay? Then up to 60, down to 30, up to 45, then up to 60, and now down to 40 again, okay? If you do not have the confidence in your stocks, do not buy this stocks, okay? Because what's going to happen, you're going to freak the hell out when it comes down to $40, when it comes down 30% in a month, like it's done several times. You're going to freak out. You're going to sell it with a loss. And then you're going to be kicking yourself when it goes back up to $60 and $80 and $100. But instead, if you do the research, if you follow the research that we do here on the channel, you're going to have the confidence. So when that stock does fall, you're going to say, hey, okay, I know this business model. I know what this business does, why it's the best in its group, and that it will come back up. And I'm not going to get freaked out. What we're looking at here in SMCI, I'm going to take you through the entire research, the entire process that I'm looking at. First, we start with that bigger picture. Even though some of those companies are a little hesitant on the AI projects, we still have an immense amount of spending towards those data centers and towards AI. Okay, $365 billion just from the big hyperscalers. Okay, those hyperscalers, the big tech users of AI like Amazon, Alphabet, Microsoft, Meta, spending $364 billion just this year in building out those AI capabilities. Okay, and that's mainly talking about data centers. All right, that data center spending to create those data centers, to buy all the hardware and software within them. And how we get that is by following that supply chain. Okay, we can follow the AI data center and AI use supply chain from the chips here, from the semiconductor makers like AMD, like NVIDIA, into the server makers like HPE, like Dell, mostly like SMCI. And so we know we still have that immense amount of money coming into these server makers like SMCI, like Dell, like HPE. Why I like SMCI here? Doing more research here. We see that SMCI talking about how it's grown its share of the server market from 3.5% in 2022. Okay, so just 3 years ago, grown that share from 3.5% to 22% of the server market. Okay, and that's because SMCI does servers better than anyone else. They do the liquid cooled. They do all the servers better than anyone else. They've grabbed more than a fifth of that market share of that server market. But here in the income statement, we can see what is really spooking investors here, and it's really coming on two fronts. Not just the AI hype cycle coming into disillusionment, not just some of these AI stocks selling off, but really a hit to profitability for these server makers. Okay, we've heard it from HPE, we've heard it from Dell, we heard it from SMCI. Really, the chips, the semiconductors that are going into those servers are getting more expensive, so their costs are going up. And their servers, the server prices that they're selling are coming down because of that competition. Okay, competition between HPE, Dell, SMCI, the other server makers really heating up here. So they're having to lower their prices to keep that sales growth. That's really hitting profitability. For example, if we go here, as early as December of last year, the SMCI reported $5.6 billion in revenue. Cost of revenue was $5 billion, right? So we have a gross profit. Okay, what's left over after paying the production costs, the input costs, cost of goods within those servers was $670 million. Okay, if we do the math here, $670 million divided by 5677. Okay, we had a gross profit margin of 11.8%. Fast forward to just this most recent quarter, and we've got a gross profit of $544 million divided by 5,756 dollars, 9.4%. Okay, so that gross profitability after production, after cost of goods, all the things that go in those servers has dropped from about 11.5% down to 9.5%. So big drop in their gross profitability. But folks, then if you look at the fundamentals of this, okay, we already know that $356 billion coming into AI spending, a lot of that going into servers, that data center spending going into servers. SMCI has a big share, 22% of that server market. We can see the analysts are still forecasting 45% sales growth for SMCI this year, 25% next to $40 billion. Okay, that is an immense amount of growth. We can look here in statistics and we can see that shares are right now trading for just 1.15 times on a price to sales basis. Okay, so that's the market cap of the stock divided by the sales, divided by, this is trailing sales. So the sales they've listed or they've produced over the past year, 23.8 divided by those sales. So sales of, we can get it here in almost $22 billion over the last year. Okay, so trading for just a little bit more than that, 1.15 times. Now this $32 billion sales expected this year. We take that here, 23.8 divided by 32. Right now it's trading at 0.75 times, okay, price to sales for this year's sales. Okay, so even if it just goes back up to that 1.15 times, that $32 billion sales this year. Let's do the math on that. 1.15 times $32 billion in sales. Even if it keeps this price to sales ratio, so how much investors are willing to pay price for every dollar in sales. Right now, paying $1.15 for every dollar in sales that this company generates. Even if it keeps that same valuation, it would be a $36.8 billion company. Right now, $23.8 billion company, so divided by 23.8, It would be a 54% return. Okay, that would take the shares to $61, back up to that $60. And folks, I think that is a low estimate of where this can go. Okay, if you look at these, first of all, if you look at any stock growing, any company growing its sales by 45%, by 20% a year, you're paying a hell of a lot more than this 1.1 times price to sales. Okay, you're paying closer to 5 times price to sales. We can see if we go further back here, this SMCI was trading for 4 times price to sales just last year when it hit, when it was coming down off that $100 price area. Okay, it's traded at 1.4 times just as recently as September or as June there. So if we go 1.4 times sales, 1.4 price to sales ratio, if it just gets up to that point times the 32 billion in sales this year, $44.8 billion market cap divided by 23.8 market cap right now, that's an 88% return from here. 88% return times $40. It is a $75 stock. This is what I'm talking about, folks. Doing this research, following through, knowing the big picture, that data center spending, who gets most of that data center spending, the servers and the SMCI getting most of that server market, and following it down into valuation. Okay, doing that research, it's going to give you the confidence to not freak out when the stocks fall like this. Okay, you need to have that confidence, and you need to do that research, not just to pick your own stocks, not just to know when some other YouTuber is just pulling stocks out of his ass and not doing any research himself. You need to do it to have the confidence yourself. So when stocks do come down, you don't freak out and you hold on to the stocks that are going to make you money. Join me on the Blossom Investing app with a special invite link in the description and see what's in my portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.